Hello, everybody, and welcome to today's presentation. My name is Sam Dolce. I'm an attorney here at Milestone Consulting, and today we are doing year-end tax planning for law firm owners, and I'm so happy that my friend Ted Jenkin is here to join us. We're going to go through all sorts of different strategies for law firm owners in ways that they can be smart when approaching their tax bill. And a lot of these strategies are things you may have never heard of. A lot of them are things you may already be doing. But really, from our perspective at Milestone, we try to bring the highest degree of financial sophistication to both plaintiffs and the attorneys that represent them. And so this is our little end of the year gift in order to make sure that you're getting advice from, one of the best financial advisors in the country. Ted's resume speaks for himself. I mean, he's been a contributor to Wall Street Journal, CNN, pretty much every major news publication. I'm really honored that he was willing to come on today and spend an hour with us walking through these really high-end concepts. If you haven't been doing these things and you want to talk to somebody regarding them, I know Ted and his team will make their time available to you. That was part of all of this, and they'll do so for free. And so you can have that conversation with us about, what your individual firm needs. But at first, we want to go over some of these, broad topics to kind of see if people are already doing the right things. I will say at Milestone, we specialize in making sure that plaintiffs are going to be taken care of now and far into the future. That means a lot more than just structured settlements. We specialize in setting up qualified settlement funds for law firms, having those detailed conversations with plaintiffs as they receive 6, 7, 8 figures. And in that, we arrange they meet with a trust attorney, an accountant, a fiduciary. We make sure everything's going to be okay in the long run. Our team is trauma informed. We also provide similar type services to law firm owners. A lot of the time, we do that in conjunction with financial advisors like Ted, who really know the space and can make a big difference. So on that note, I'm going to pass this over to Ted and really let him sort of own this presentation. We're going to be going into all sorts of interesting areas. If you have questions, please ask them. There's a questions tab on the right hand of your screen, as well as a chat. You can ask them either of them. After Ted's presentation, we'll do a little Q&A. I'll read through the questions for Ted. If any question goes unanswered, we'll make sure that it's answered in email format later on. And if we think that's going to be a positive answer to share with everybody, we'll just send an FAQ sheet out to everyone who's able to attend. Recording this will also be available if you need to share with your partners, things like that. We'll send that out in a few days. So anyways, thank you everyone for joining us today. And with no further ado, Ted, please take the reins.
All right, thanks, Sam, and thanks to John and everybody at Milestone for having me on here today. Sam, do you still see my screen and everything like that?
Yes, I do.
All right. That's why I just want to make sure if you put in the questions, as Sam mentioned along the way, if you have questions, feel free to put them in here. We will answer them along the way. I just want to make sure everyone can hear me and the screen is good, and we'll get ready to roll here. And then I'm going to probably spend about 30 minutes talking about tax ideas. I want to spend 10 minutes talking about the economy and a little bit about what we might see going into 2022, especially in light of the remarks yesterday around tapering and what may happen to interest rates going into next year, and how you may be thinking about that. But all the time, I would say over the last 10 years, we get questions from entrepreneurs and business owners asking, what can I do to save money? What can I do in terms of year-end tax planning? And unfortunately, many business owners, including law firm owners, sometimes are a day late and a dollar short because it's not as easy at Christmas time to put together 52 strategies. So some of these things I'm going to talk about can be done before year end. There are other things I'm not going to talk about today simply for the fact that you probably won't have enough time to do them, but I will make a mention of them along the way. We have worked with so many hundreds of law firms now that we've created something called the Attorney Tax Blueprint. And I do recommend at some point that your firm goes through this, because CPAs are great people, But what I have found over 30 years of doing this business is they tend to look at things from a retroactive point of view. So if you make $2 million this year, by the time that you file either in April or you wait to September, they're like, well, don't be mad about how much income tax you have to pay. You know, you made a lot of money. That's not the answer. The answer is within the tax law today, what's legal, ethical, what's moral, what can you do in order to save money on your taxes? As Sam mentioned, I'm 30 years into this business. I carry 6 advanced designations, and I have been very fortunate the last 10 years to be doing national TV. If you go on this weekend, I'll be on Headline News, which is a CNN sister station on Saturday and Sunday, but I'll go on to CNBC, CNN, Fox, and then write pretty regularly for the Wall Street Journal. So one question you want to be thinking about, not just for year end, but going into next year, is over the next year, over the next 3 years or 5 years, where do you expect taxes to go? Because to prepare an effective tax plan, you have to think about 2 phases of your life. You have to think about accumulation, you know, the period of time while you're growing your assets. And you also have to think about the period that I call decumulation, when you're actually taking money out of your accounts. And because we don't know exactly where tax rates will be in any given 4 years per se, we've got to constantly have multiple bullets in the gun in the way that we set up accounts to make sure that we minimize taxes today, but we have a way to minimize taxes down the road as well. So part of it is a holistic strategy. It's not just done 1 year at a time, but you knew just a few months ago, you heard Congress, the Senate, banding about, talking about having a major raise in taxes. As you may have seen, the tax tables came out for 2022. Nothing has changed as of yet. Does that mean they won't retroactively change it backwards somewhere in 2022? No. But I want you to think about this over time. Simple math is for your business, my business, any business, if you've got a problem in the business, you either do one of 2 things. You figure out how to increase revenue or you figure out how to decrease expenses. And the government doesn't have any problem. Look, their motto used to be "In God We Trust." Now the motto is, don't worry, we'll print more money. That's basically where we are today. As you saw, the debt ceiling, that's probably going to get raised as well, and we'll be about $30 trillion in debt. So you have to have a way to pay that off over time, and if you do, how do you do it? You have to raise revenue or decrease expenses. The only revenue that we get is through taxes. We get tariff taxes, estate taxes, corporate taxes, personal income taxes, payroll taxes. There has to be a way to extract more tax out in order to be able to get revenue. And those taxes can come from everything that you see on the screen in here. Sales of businesses, property sales, payroll taxes, incomes, potentially gift tax, as I mentioned, tariff or import tax, dividend tax, all along the way. Each of these different kinds of areas may have unique strategy to figure out how to minimize taxes. That can happen through things like tax shelters. It can happen through tax deferrals. It can happen through tax credits. It can happen with tax exempt investments. There are a multitude of ways to do it. But what you don't want to do, and we're going to do as much as we can today, is you really don't want to be sitting here on December 15th saying, oh my gosh, I made $1 million. I made $2 million. I made $5 million. What am I going to do to minimize my taxes? Typically, I like sitting in the beginning of a year with one of our clients and saying, where do we think things could end up? Yes, you may not know if a case is going to settle, or you may not know exactly what your run rate is going to be, but you can start to get some predictability about where you think you'll be and plan out the strategies, not only for 1 year, but like I mentioned, many years to come. So for attorneys, as Sam mentioned, and I know Milestone is the best of the best at this, one thing that you may think about if you're in the contingency business as an attorney, whether you settle personal injury or you're a class action or you're in mass tort, is using something called a 468B trust. Now, historically speaking, many attorneys, when they settle a case, were hit up by annuity companies and annuity salespeople to get to do something called a structured settlement. You know, so you settle for $1 million, you buy an annuity, they pay you out. I'm keeping this simple, $100 grand a year for the next 10 years, and that way you've got some spread on your taxation. Can you imagine today that if you knew that you were going to get $1 million as the fee that was paid to you as the attorney, and we had a way to set up an unlimited 401k plan. We had a way to set up an unlimited deferred compensation plan. Well, under the tax law, that's where you see 468B, and it's called a 468B trust. Milestone obviously is great at settling these up. They're commonly referred to as qualified settlement funds. And when there are large settlements, we're seeing this from some major mass torts that are starting to get settled out now, it allows you to essentially not take constructive receipt of the fee that would be paid to you as the attorney. Now, the plaintiffs can do this as well. I'm not going to talk about as much about that today, but in that $1 million, you could choose, and I think Sam might have mentioned this in the beginning, to take $200,000 of that million. You could take $500,000 of that million, or you could take all $1 million and you could stick it into this QSF or qualified settlement fund or the 468B trust as it's known. When those dollars go in there, you have not received constructive receipt of the income. Consequently, here in 2021, or if it happened to you in 2022, you're not going to show that money on your federal tax return. So as opposed to showing $1 million of income, if you put half of that in the QSF, you would only show $500,000 of that income. Now that's $500,000 that won't show on your tax return. And depending upon the state you live in, if you were going to be in the 37% as it stands today, federal tax bracket, if you've got state taxes, let's say it's 6 to 8%, you could be closing in all in on 50% tax rate. You've got a $250,000 tax save. So what it does is it gives somebody as an attorney or a firm, because it can be done firm-wide, it gives you time and space to really think through your financial plan, as opposed to being shoved down the last minute with a lot of money in your hands and thinking, gosh, I'm going to give half of this to the federal government. This strategy is growing like wildfire, like I said, for people that are in the contingency business. So when you get this to happen, if you choose, you can defer the fee into this account. Now, I mentioned just a minute ago that annuity companies, they really wanted to go after your money, but you got to think about it. Even if interest rates go up, most annuities right now pay a ridiculously low rate of return. So on the 468B, you've got your own investment account. And as we direct that investment account, you can buy stocks, you can buy bonds, you can buy mutual funds, you can buy exchange traded funds, you can buy real estate investment trusts. There's all kinds of things that you can buy in here. So a lot like you might manage your 401k today, or your IRA, or your brokerage account, you can manage that money the same way. So now imagine $500,000 got deferred, it went into this account, and let's say over the next 10 years, you could earn 6, 8, 10% or more on your money. Think about how many dollars that will be, and if you time it right, depending upon where your income is down the road, you may in fact pay a lower tax bracket because maybe you won't be in the same tax bracket you're in today. This is a massive year-end strategy that can be used. There are a few nuances in here. Obviously, working with Milestone over the years, they're the ones that would set up all the legal and qualified agreements to get this done. You're going to have to decide beforehand. Money has to basically be placed into that QSF. It can't hit your account. And then companies like ours generally facilitate and help on the back end in what to do with that investment money. But you can be involved in the direction on how that money is invested and the way that's invested. That can be a massive tax save, not just this year, but in future years, as long as the tax law stays where it is. So one of the things you might want to be considering now is tax loss harvesting. You know, it's been a good year overall, and it should be for you as you look at your accounts and the rates of return, just thinking about where the major indexes are today. But many, many people, and I can tell you, never do accountants do this, they just don't do it at all, is to look at strategically in your accounts about what investments you may want to sell, either to take capital gains or to do what's known as tax loss selling. If you've got a non-qualified account, i.e. a brokerage account, not an IRA, not a Roth IRA, this strategy can be successful. So maybe you look at your portfolio and you have 15 investments that are in there, and 10 or 12 are winners right now and 3 are losers. If the losers are there and you sell those losers now, you're going to be able to embed that tax loss. And so in the future, if you sell capital gains and you make those capital gains, you can actually use those capital gains against your existing losses. Remember, in any tax year, if you have more losses than you have gains, you're only going to be able to take $3,000 of those losses against ordinary income. However, you can match an unlimited amount of capital gains against capital losses. So if you had a loss of 50 grand and you harvested it and let's say the government raised capital gains rates to 30%, or they were talking about 39.6%, you're going to be able to carry forward that loss and be able to use it against future gains. Tax harvesting is very important. And by the way, if you actually like the stock or you like the fund or whatever it may be, just remember this: the IRS has something called the wash rule. And it typically means that if you take a loss on that security, you decided, oh man, I bought Rivian and it went public and I thought it was going to be great, and it went from 150, now it's at 110. I'm down 40 grand. I'm not saying you might not want to own Rivian over the long term. What I am saying is harvest the loss and then 31 days later, go back and buy the stock again, right? A lot of people just don't do that. They don't look at their portfolio that way, and they don't actively manage losses during the year. And definitely CPAs really never look at this at the end of the year. I'm just shocked by it, but they generally don't. The one thing I will tell you that's sort of a caveat in there this year, some of you that are on the call today might have gotten active in crypto. I don't know whether you did or you didn't, and you may have money at Coinbase or Gemini or Binance or Kraken or one of those platforms. If you bought crypto, remember it's your responsibility to track the cost basis. So the IRS now has a box on the tax return. We're experts at crypto, by the way, which is a totally separate thing. But the thing I want to tell you is that when you have that crypto, it's going to be your responsibility to track the basis. So maybe you were getting all excited, just a few weeks ago, a month ago, and you bought Bitcoin at, 68,000, and now Bitcoin dropped to 48,000. So now you're like, well, shoot, I'm down 20 grand on one Bitcoin. The beauty about cryptocurrency as it pertains to the current rules with wash rules is there are none, which means technically you could go into your Coinbase account, your Binance account, your Kraken account, sell the cryptocurrency, take that $20,000 loss, and then 1 minute later, you could buy it back. You're not subject to wash rules in order to take that loss. So people forget that in the world of capital gains and losses, it's now not just talking about stocks, bonds, mutual funds, exchange traded funds. We're now talking about crypto as well. And I think there are a lot of investors that do not understand the wash rules as it pertains to crypto. And I think there are a lot of investors that actually are not looking at where their gains and losses are in crypto. I'm not saying you shouldn't hold the crypto long term. You could sell that Bitcoin and literally a minute later, you could buy it back and you could lock in that loss if you had it. The prices do move quickly, so I probably wouldn't wait 31 days. The market tends to seem to move every 31 days right now, but I would look at those overall. Really important thing to do. Now, the consideration if you have gains this year is that inevitably we think capital gains rates are going to go up. The last pass of where this was to move capital gains rates to 25%, but potentially also include something called the NIIT, which is the net investment income tax. And some people call it the Obamacare surtax, which is a 3.8% surtax on top of the 25%, which would take it to 28.8. None of that's been passed. None of that has been approved right now. So for all intents and purposes, it may be that capital gains rates are still at 20% next year. But inevitably, when the rules came around and they were talking about the change in taxes, one of the reasons people like to hold on to appreciated assets forever is today, the rules state that when you die, your inheritors will get a step up in cost basis. So if you bought Apple at 100 grand cost basis and it's now at $1 million, and you die and your kids inherit it, their cost basis today will be $1 million. Well, you can imagine the government doesn't really like that, because then they never see their income tax on that 900,000 of growth. So none of that's changed either, but you may want to consider to say, look, if I was going to pay taxes, maybe it would behoove me or benefit me to just pay 20% if that's where I'm at my tax bracket wise. Below that, capital gains are 15%. But here's one trick. Let's say your law firm had a terrible year, and I'm hoping it didn't. I hope you did make a lot of money. But if you didn't, and for some reason this was a rotten year and you're going to show a loss, just remember that up to a certain income amount, the capital gains rate is 0. So there's a possibility to sell stock or ETFs or funds where you've made a lot of money, crypto included, and you could say to yourself, okay, well, I may only pay 0 or 15%. I might as well just pay it and re-up my basis. So that's kind of the food for thought, because if this did go to 39.6%, what you're going to see on TV is they're going to say that's not that bad. It's only a 19.6% increase, which is a complete fabrication. It actually is a 100% increase. And I just showed you a math example that going from 20 to 39.6% means your tax goes from 200 all the way up to 396,000. So stock sales, business sales, certain real estate, crypto, eventually they'll probably get rid of the crypto wash rules. It just doesn't exist that way today. So if you did have a capital gain this year, or you had one recently, one thing you may want to consider, and you may not have looked at, is something called a QOZ, or a qualified opportunity zone. Sometimes you might hear this as a qualified opportunity fund. As I've met a lot of lawyers across the country, because you are law firm owners and entrepreneurs, most entrepreneurs really like two asset classes. They like their business and they like real estate. I'm not saying they don't have some money in the market, but they tend to lean towards real estate and owning their business. And a lot of real estate owners like real estate because they use something called a 1031 exchange, which some of you have, which means when you sell the property, you can continue to kick the can down the road and defer taxation by moving your real estate asset into a like-kind property. Can be tricky, generally has a shorter window, but in 2017, when the Trump Tax Cuts and Jobs Act went into place, they created this concept called the qualified opportunity zone. The states basically were able to nominate cities in their state that they felt were underdeveloped or underprivileged areas. And in 2018, the Treasury approved those areas in every single state in the United States. And this started creating what's called to be qualified opportunity zones. So how this works is that if you sell anything, a business, real estate, stocks, crypto, what you can do is essentially take your basis out, because, right, there's no double taxation. So you're not going to be double taxed on your basis. You already paid tax right now. Remember, in a 1031, you've got to roll your basis. In the QOZ, you don't have to roll your basis. You can just roll all or part of the capital gain. And when you roll it, you can put it into your own kind of real estate if it exists in a qualified opportunity zone, or you can buy a qualified opportunity fund. If you do this and the investments are held for 5 years, you have a 10% step up in basis, or it means that if your capital gain was going to be 20%, now the capital gain on the original investment would only be 18%. And if you hold it for 7 years, then that actual capital gain rate would go down to 17%. But if you hold the investment for 10 years, or you hold the sunset, all of the growth on that real estate, assumptively saying here that you pick the right real estate investment, you'll have no tax on the growth of that investment. So imagine you rolled the $1 million gain into a property and that property grew to 2 million. Yes, you will still have to pay capital gain on that original million, but it would drop down to 17%, not 20. And all of the growth of that property, you're going to pay no tax on it whatsoever. So this is a very interesting thing. Right now, as it stands today, let me go back on here. There's going to be a sunset of this in 2026. We're not sure if they will extend it or they won't. I mean, obviously, you could say it matters who's going to be in the White House. I would tell you that this was one of the things that passed that actually everybody got along, because it does put money into economically depressed or underprivileged areas. And at the same token, people that have assets or gains can also get a break taxation wise. And if they pick the right real estate, get an additional break. So QOZ has a 6-month window. So if you sold an asset in October, you might still be able to do this strategy. If you sell here in December, it's not like you have to do this by 12/31. You'd still have 6 months to figure out what you're going to do with the money. But this is something you may want to be thinking about for your year-end tax strategy. Now, if you had a bad year overall in terms of income, or it was subpar for where you thought you would be, I'm always telling people to just every year look at considering a Roth conversion. I've seen some law firms, especially in the mass tort space, where I know it can be feast or famine. And if you had a year where you're showing a $500,000 loss, it would be foolish not to try to convert your 401k or convert IRAs and just convert them into a Roth. because if you converted $300,000 of IRAs and you had a $500,000 loss, you're not going to pay any tax on the conversion. One of the things that people do not realize, I really don't think people have looked at this, with your IRA and 401k accounts. At the end of 2019, the government created something called the Secure Act. And in the Secure Act, what was critical about this is they changed two things. One is they changed the required minimum distribution to the age of 72. So no longer is it at 70 and a half, it's now at 72. That sounds like good news. Here's the bad news. A non-spouse, let me say that again, a non-spouse inheritor of an IRA 401k account only has 10 years to take out the money. So it used to be that you could stretch, or they would call it a stretch IRA, stretch that money over their lifetimes. No longer true. The government wants the revenue. And that means that they've only got 10 years. However, Roth IRAs do not fall under that category. So in any way, shape, and form, to the extent that you can get to a Roth IRA, it isn't just the fact that the money comes out tax-free down the road. It's just the way that the asset can stretch out in your overall estate plan. So if you're in a lower tax bracket this year, or a year that the law firm showed a loss, this could be really interesting. Currently right now, AGI doesn't matter in the conversion, AGI standing for adjusted gross income. But I will tell you, the government is looking at this closely on wealthy people. They call this sort of the Peter Thiel rule, because he's able to create, tons of money inside of a Roth IRA, and they don't like it. So I don't know if it'll last forever. I just know where we are today. That being said, two things to be thinking about while the rules still exist. I know most of your law firms probably have a 401k and some sort of profit sharing plan. I want to tell you 100% that if you haven't talked to your broker or your third-party administrator or whomever is handling your plan, it should have a Roth 401k. That's a given. More importantly, there's specific code in your summary plan description. This is the document that overrides the 401k plan, and it should allow you to make after-tax contributions. The reason you want to do that is that there's still a major loophole. It is called a mega, M-E-G-A, that's why I capitalized it on the slide, a mega backdoor Roth IRA. That mega backdoor Roth IRA will allow you to put away almost $40,000 a year of after-tax contributions, and then immediately take it out of the plan and put it into a Roth IRA. So a lot of people know or have heard of the backdoor Roth IRA, where if you're under 50, you could put away $6,000 in a traditional IRA. If you're 50 or older, you could put away $7,000 and immediately convert it into a Roth IRA. That seems like for most of you, it could make sense. But the mega backdoor Roth IRA, if you have the cash flow, is massive. There's a two-step process to make it happen, but if your summary plan description is not right in your 401k plan, you will never be able to do it. Most financial advisors, brokers, insurance agents, they just don't know how these things work, so they never recommend them. So you may be sitting there like, well, why hasn't my person talked to me about that? People don't necessarily follow the rules, and sometimes, as you know, if they don't make money or a commission or whatever, they won't recommend it. So that I would look at for sure going forward. This is about thinking about that decumulation period down the road. Now, if you had a really good year, an example of this is that we had a contingency fee law firm in California, and they did incredibly well this year. So we talked to them about the QSF, but what they set up is something called a cash balance or a defined benefit plan. Again, a lot of law firms will have a 401k, they might have a profit sharing plan. Those are called defined contribution plans because you define the contribution. Currently in 2021, you can put away $19,500 into the 401k. You can put away another $6,500 as a catch up if you're 50 or older. And then depending upon the firm and profit sharing, you can get yourself out to 60,000+ and change. In a defined benefit plan, you're actually defining the benefit. You're not defining the contribution. So the IRS will look at your age today, they'll look at your retirement age, and then they actually use an actuarial calculation to figure out how much money you need to put away today in order to be able to get that benefit down the road. And these numbers can be massive. I'm just showing you an example here of a sole proprietor who's 55, and maybe you have your spouse who's working in the firm. If not, maybe you put them on payroll and they work in the firm, and the practice is making more than $500,000. In this case, I said the practice is making $1 million. When I ran the math on these as an example, this couple in the pension plan alone could put away $524,000 pre-tax. Now, this will vary from firm to firm because some of your firms, you may be a solo practitioner, or it's you and 1 and 2 staff people. Some of you may have 10 lawyers that work in the firm. There's a number of ways to skin the cat in here and how to design these. I mean, it's part science and part art, but I just think there's a lot of firms that just have not looked at these as a way, especially year end here. Here's the good news. I want to make sure you remember this from today. These only have to be set up by the end of the year, okay, in order for you to qualify. You don't have to fund them by the end of the year. Technically speaking, they can be funded as late as 9/15/2022 in order to be able to save money here in 2021. So you'd still have a full 9 months to basically flesh this out, think about which way that you fund it, but they can be incredibly powerful in saving money in taxes. And again, some of you may be solo law firms, some of you may have multiple partners in the firms. There's a number of ways in order to be able to skin the cat. But these defined benefit plans we have done for many, many law firms of many, many sizes. And even if you're a contingency firm, one of the things I'll often hear is like, well, you know, I only have 1 good year and then I have 2 not so good years. So what? It doesn't matter. We figure out how to calculate salaries or incomes and figure out the actuarial calculations so we stay within the IRS guidelines and formulas. Very, very, very powerful stuff. I will tell you that in general, excuse me, there are wonky tax ideas that people have shown me over the years, and they have been successful over the years, but they're getting more difficult. I probably would stay away from the whole land conservation easement unless you own your own properties. Those are being highly audited right now. Captive insurance companies can be a good thing, but they've got to be structurally set up right in order to be able to reduce taxes. And if you have an IRA account, that's a traditional IRA, there are still rules that allow you every year, 1 year, to make a IRA to health savings account rollover. So technically, you could take a traditional IRA and roll over 1 lump sum into an HSA account. Remember, if you use that as a health account, it's a triple tax-free account. But the captives and the easement stuff, I would be a little bit more cautious on if they're not set up right. They're under a little bit more scrutiny. So in this case that I showed you in the defined benefit plan, this is a $300,000 tax save. The contributions can be variable. They're not necessarily fixed. There are ranges every year, and if you had a bad year, you can skip a year. But a lot of smart small businesses, medium-sized businesses, we have the best actuaries and pension team in the country, and we've set this up, you know, many, many, many times. This would be something to look at. Okay, let me hit on 2 other small things in here. If you're going to just use the standard deduction, which some of you that have paid off your mortgage, you may be using now, I want you to remember it's a very small tax save, but individuals can still take $300 of cash contributions, married couples, $600 of cash contributions. And if you itemize, especially on the non-cash charitable contributions, really just make sure you're getting what you should. Last year in the US Master Tax Guide, the average itemized charitable contribution was around 1.5% of gross income. Just to give you some perspective. So sometimes people give away a bag of goods and they basically, you know, way undersell what that bag of goods is worth relative to the real value. But underneath what happened with the CARES Act and what carried forward into 2021, if you're doing cash contributions, and I'm not saying you have to do this, but if you do it, you can technically get up to 100% of your adjusted gross income. Normally, when you're giving to charities, it usually will end up at 50% of adjusted gross income, but 100% of adjusted gross income for cash contributions, just remember that if for some reason you're going to make that kind of charitable donation. And if you have way high appreciated assets, real estate, stock, and you're trying to think about a longer term plan, we don't have enough time to go through all this today, you may want to consider setting up your own family foundation, your own charitable lead trust, or there's something called a NIMCRUT. And a NIMCRUT stands for a net income makeup charitable remainder uni trust. And all I'm going to tell you is there's a reason that celebrities and athletes have family foundations. And when you work through the math on it, the tax deductions they give you today, the way that you can replace the assets for your family down the road, and the good that you may be able to do for society in the middle, it's an incredible structure if you understand how these work. And again, this depends on your age and your assets, but could be something to look at. So I just wanted to hit on those. There are obviously other things that could be done. I know that we've got a limited amount of time, and I did want to comment for about 10 minutes on the economy and just tell you that, you know, the basic economic laws that you learned in high school or college haven't really changed. And what we're really seeing right now is just this massive game of supply and demand. And it's hit on a multitude of fronts. You know, obviously when people see a gallon of gas, which was $2.12 a year ago, and it's at, you know, $3.30 something today, we've seen a massive rise in that. All of you are feeling it at the grocery stores. And many people think that this is 100% a supply chain issue, when in fact it's not. You know, and you're seeing this, is that we printed a lot of money. Not all that money is in the marketplace yet today. It'll take years for all this money to actually get in the marketplace. And the reason the stock market stays high, the reason real estate stays high, is simply over the law of supply and demand. You know, when you have cash that's sitting in your bank account and making 0.1, and you have no other ways that you can make money on fixed income, of course that money is going to chase something. And right now there's a lot of supply of the money. You know, there's a huge appetite for private equity, for real estate, for regular equities, and they have huge demand. And that's why you're seeing prices continue to go up despite the fact of what we saw yesterday. Some people, obviously, with it being front and center now, are noticing inflation, and remember how inflation may impact your overall investments. Last month, it was a 30-year high at 6.2%. That was in October. This past month, we were at 6.8%. And if you're going to sit on cash over time, if you think about it, all you're really guaranteeing yourself is that your cash is going to be worth 6.8% less than it is today. So people say cash is safe, and that's true to a degree, but you're also safely going backwards. We do not think that inflation is going away anytime soon. We don't think that we're going to quite hit the double-digit years of the late Carter, you know, early 80s before things came back into line. But to think that inflation will hover back down at 0 or 1%, I think it's highly unlikely. We just think that as a firm right now. So you've got to consider how that may affect various investments. And if interest rates have 3 hikes next year, you've also got to think about how those interest rate hikes may affect your overall portfolio as well, as cash gets to be a little bit tighter. So one tip I wanted to give you today is that you may have never invested directly with the government. And you may remember as kids that you got savings bonds. The likelihood is that they were double E savings bonds, like your mom or your grandmother, aunt, uncle bought you a $50 bond. Face value, they paid $25 for it. And eventually, after a certain number of years, it was going to be worth $50. The Treasury today, and I've done this already, so it's not complicated to do it. You can go to treasurydirect.gov. I wrote an article on this in the Wall Street Journal. I did one on the USA Today around this, and they offer something called I-bonds. I-bonds, I standing for inflation. And the way I-bonds are built out from a rate of return is that generally there's some nominal fixed rate that's on the bond. And then every 6 months, it's off of the consumer price index. So currently, if you go on to treasurydirect.gov, it's 7.12%. That doesn't sound so bad. And by the way, these are 30-year bonds, but if you take your cash early, you generally have to pay 3 months of penalty of interest. But think about it. If I paid 3 months of interest, let's say it was a year later and I got 7.12%, and I paid 3 months of penalty, so what? If my net return was 5%, 5% is a hell of a lot better than 0.1 or 0.2, or maybe you're even getting 0.5, I doubt it, from your bank, but that's something to be thinking about. And if you don't want to do it through the Treasury, you may look at your own portfolio or talk to your own broker about tips and thinking about that being a different sleeve of your bond portfolio relative to having corporate bonds. Remember this, bonds and interest rates have a seesaw relationship. So if interest rates get 3 hikes next year, you can rest assured that most of your corporate bond funds will see a decline in net asset value. So this is something to be thinking about, because a lot of people that set up a blended portfolio, the bond portfolio is not often managed, but that may be a consideration. You might also want to look at commodities. If you're griping a little bit and thinking, gosh, I'm so tired about prices going up. I see, everything going up. Turkeys over Thanksgiving, and I'm seeing, hamburger prices go up. Yeah, and they probably will go up. And some of this is a supply chain issue, and whether or not you're a gigantic believer in climate change or not, the truth is that the weather patterns have wreaked havoc in places like Brazil that saw heavy frost last year, where we saw coffee and sugar prices that are way up. Those of you that live out in the western part of the country, especially the Pacific Northwest, you obviously know what's happening with wildfires and extreme weather patterns and heat waves, and that's caused wheat prices to be at an 8-year high. You know what's happened with corn prices as well, which affected turkey this year. And so, generally during inflation, commodities do well, but in addition to what we have with weather and the supply chain, this could be a good hedge to be thinking about for inflation. And real estate tends to do very well. Apartment prices have never been higher in the country. You've really got to look closely at the cap rates if you buy into these and the way that the debt structure is being done. But apartment buildings, warehouses, public storage, all may be things to be looking at during this time. I can answer questions on equities if we want at the end. So the last comment I'll make on this is that you kind of got to decide going into next year, which investor are you? Are you FOMO or FONGO or neither? FOMO being the fear of missing out, like should I be putting more money in? What happens if the market does another 20% next year? Most of the pundits on TV, they're wrong most of the time. Jim Cramer's been more wrong than anybody I've ever seen, but people still love him. And the other side of this is the FONGO, which is the fear of not getting out. Like, should I put cash on the sidelines? Is there a way to get a protection? There are a lot of intelligent ways to put protective bumpers like you would on a bowling lane on your overall portfolio. What I will tell you, because I've been doing this for 30 years, is I saw part of this movie in the 90s. The valuations aren't quite today exactly the way that they were in the 90s, but the 90s, we had 5 years of a run that averaged 28.7%. This year, we're on a 3-year run, including the massive tanking that we had during the coronavirus, at 25.3%. So is it possible it will continue on at this level? We don't think so. We don't think it's sustainable that you'll see 2 more years like you did in the 90s at 25%, but we don't outright think there's going to be a market crash. What we do know is in any year where the market has 50 record highs, i.e. 2021, we've had 50 record highs, the average return in the year following is at 6.7%. So when you look at the S&P 500, you may be thinking more in the tune of 6 to 8%. Now, some people are saying 5, but what you've been seeing, that huge double-digit return, hopefully for most of you, I'd probably scale back expectations unless you're going to get knee deep in the stock picking game. So I would look at that. And then the last comment about this is that if we print more money here and there's another $2 trillion that are put into play, the speculative world has surged way higher than the S&P 500. Those of you that have been meme traders and traded GameStop or AMC or those other ones, or like I mentioned, you're heavy into crypto, Bitcoin, ETH, Cardano, Solana, Polkadot, Kusama, any of them, or you're chasing IPOs like Rivian, they're getting chased right now simply for the fact that money has to go somewhere. That's why personal businesses and these kinds of stocks, I think you'll continue to see that kind of speculation going into next year. Just make sure, I used to fundamentally chart and technically chart these things, and we still do, but you've got to look at how the media and social media impact them. We would be ignorant not to do that. So with that being said, I know I said a mouthful here in the last 40 minutes. I want to thank Sam and John and Milestone for having me on today. If you're on today and you're thinking, man, I would love somebody to look at the last 3 years of my corporate and personal returns and tell me where I can save money, either retroactively go back and get it, or look at it going forward to the end of 2021, simply go to oxygenfinancial.com, put your name in there, and as Sam mentioned, at no charge at all, our team and me, we will look at these last 3 years of tax returns. We will give you some basic, like what we find to be as red flags, and then you can determine at that point whether or not an attorney tax blueprint would be right for you. If the QSF popped out of you right away, that may be an easy one, but there are so many strategies. But a lot of times we got to look at the returns to look at your business and your personal situation and think about the best way to orchestrate a tax saving strategy to put more dollars in your pocket. So all you do now is just go to oxygenfinancial.com, just request the consultation. Look, we'll turn this thing around. We work at this time of year, at the end of the year. We know it's busy, but we also know if you had a great year, you don't want to pay more to the government. I don't know about this whole fair share thing. I think you get what, as you know, as attorneys, you get what you negotiate. You get what you put together here. If you don't spend time making a plan, then you're probably going to pay more than you need to. So that being said, Sam, I'm going to turn it back to you and open it up for questions.
Thanks so much, Ted. Wow, an hour goes really fast, and that was a lot of information. I'm assuming we're going to have some questions come in here, so I'm just going to kind of let that happen. Again, if you have any questions, please enter into the chat or in the questions portion. I know we have a lot of attendees today, so I'm assuming some stuff may come through. You also can always email us, both for information. You can just Google it. And
yeah, and even if we didn't cover it today, Sam, I mean, you can ask whatever you want. I mean, I'm an open book. I mean, I'll answer whatever you got on here, whether it has to deal with taxes or structure or investment stuff. I'm happy to answer anything I can, because we'd love to figure out how to keep more of your hard-earned money in your pocket.
There's some questions coming in, but I like this one. How do you remember all that stuff? It didn't look like you were looking at notes, so that's my favorite of these. But
the funny thing about this is, I'm sure you were listening to this and thinking I was like reading off of something, but I'm not. As you can appreciate as a professional in your industry, I think that there are a lot of people that are really should not be giving financial advice, and I spend many hours studying these things. And look, when you're on a panel in the Wall Street Journal or CNBC and these things, you got to know what you're talking about. This isn't, you can't make this stuff up. And so, Sam, I just spend tons of time looking at this stuff, looking at tax returns, and thinking about how we save people money. Because like I said, part of this is science, but part of this is art. You have to understand the code, as you guys do with attorneys on contingency fee attorneys, and learning how to set up these structures that are legal, and they're not going to have the IRS banging down your door, and they work. But you got to think about this. A lot of CPAs don't spend a lot of time doing this, and again, I'm not knocking them. They just don't. They're more reactive than proactive, and is what we do.
We have a question, which is more of a technical question. I actually can answer this one. How do you get the defense, assuming defense attorney or defendant, to agree to paying the settlement into the trust? I'm assuming they're talking about a qualified settlement fund or a 468B trust. Generally, that's relatively simple. I file and establish these all the time. It's typically no to the naming of how we actually label the qualified settlement fund. It'll typically be the name of your law firm settlement account. And all we need to do is ask for defense to pay to that fund and provide them the proper TIN into that account number. There usually is not a big stink about it. There's no duty to disclose. You're just asking them to pay a litigation trust instead of your operating. And there's no reason for them to start digging into it. It's just business as usual. They make out the check, we're able to deposit into the QSF. If it's going to go further than that, then it has to be a point of negotiation when it comes to the settlement. If we're talking about a 7 or 8 figure settlement, what we're talking about is, potentially tens of thousands in tax savings to your client, probably something you should be fighting over anyways. But mostly we just avoid the issue altogether by labeling it the name of the law firm settlement account. Here's a question. This is definitely going to be going to Ted. It's a little bit longer, so please stick with me. Regarding the defined benefit plan discussion, sole owner, does it make sense to have spouse on payroll? And do you maximize spouse's salary to increase amount you can contribute to defined benefit plan, or does salary not matter? As an asterisk to this, what about your kids? Should your kids be a part of that as well?
Yeah, let me take this backwards. I own multiple companies, and not having your kids on payroll is a huge mistake. And let me just tell you why. When the tax laws changed, a lot of people are like, well, I don't want to lose dependency status. And the funny thing is you don't even get a personal exemption anymore in your tax return for your kids actually being a dependent. So as an individual, remember they changed the standard deduction where it's roughly $12,650 a year. So technically, I could pay my kid $12,650, assuming they qualify, and I don't pay tax on that money, right? It comes off of my tax return. They don't pay tax on that money, and then I would fund their 529 plan. Then I would fund a Roth IRA. Then I would fund the UGMA or the UTMA. A lot of people ask how old does my child have to be? Recent case law, I wouldn't do it necessarily at this age, but recent case law had a child as of the age of 8 who was a Microsoft certified expert. So it's pretty funny. But I would say, once your kids are in that 10 to 12 range, especially with social media today, have a job description on file. It's a no-brainer. You don't fund the 529 plans with after-tax money. That's crazy. You could do it with pre-tax money. As it pertains to your spouse, yeah, it's absolutely great to have them on payroll. First of all, they could qualify, if you're just a sole practitioner, they would qualify as another employee for the defined benefit plan, and that really can up your contributions as a household. Second of all, remember, by paying them a salary, they also get money into Social Security. So down the road, yeah, it's true they could get half your Social Security, but on the other hand, they may be able to get a full Social Security as well. And I know some of you may be like joking right now and thinking, well, we don't even know if it's going to be there. I mean, we don't. We'd be in rough shape if it wasn't. So I don't think it's going away, even though you'll see articles every year about the Social Security Trust running out of money by 2033 or 2034. But I think spouse on payroll, great thing for that 401k, profit share, defined benefit plan, and kids on payroll. I love it. And by the way, remember, I'm not telling you have to put your kids on the board of directors, but if you do, there's other small nuances of tax deductions that could be involved in there if they're involved in the business. So all good considerations for how you structure strategy.
Great. Thank you for that. I'm waiting on more questions to come in. We just had those 2 off the bat. If anyone still has questions, please ask now or send us an email later. But I mean, we're coming to the top of the hour regardless, so we may just be winding this thing down. Ted, I really want to say thank you. I know as a practicing attorney, someone who's watched, seen a family law firm operate, how important these conversations are. So many times attorneys are spending all their time on their caseloads, taking care of others, right? And they don't necessarily take the time to review what they need to do for their own practice. I can't tell you how many people in the personal injury space will operate their law firm for years without really sitting down and getting to these answers, right? They'll hire a typical CPA that's, they're not used to working with law firms. They don't know what a 468B trust even is. And that's no fault of their own, right? They're operating for all sorts of businesses. They're just not specialized in the space. And because of that, a lot of these attorneys miss out on hundreds of thousands, if not millions of dollars over the course of their career. And so what we regularly see is when the law firms make the decision to really get serious about the way they're running their business, they'll see a lot of growth. We have one more question that just came in. Any thoughts on the commercial real estate crowdfunding sites like CrowdStreet or Fundrise, etc.? Also, will you review a law firm's defined benefit plan if it's already in existence?
Yeah, and I want to make one other comment besides this. By the way, I like Fundrise. I like both of those crowdfunding spaces, but I like Fundrise. I've got personal money in Fundrise, so I've used it. I'm less of a fan of some of the other websites that are on the debt side, like Prosper and Lending Club, but Fundrise is a pretty interesting platform if you don't really want to do commercial real estate on your own. Obviously, I love owner-occupied real estate if it works for your firm and you can manage your growth. I love that, every single time while you're building a law firm, it's a great deal. So I like both of those sites. I did want to comment too that there's been a bunch of attorneys that make a lot of money that are in higher tax states, like California as an example. I'm not sure if people are on from California today, but there are a number of nuances that the states have passed right now regarding a reduction of the SALT taxes if you structure stuff right through your business. The SALT taxes were capped at $10,000 for state and local income tax, along with real estate taxes, but there's kind of a workaround in some states now that have passed some laws while the government is figuring out whether or not they want to get rid of the cap or move the cap to 80,000 or keep it at 10. So that's interesting. And yes, we'd be happy to review the current documents of a defined benefit plan. Often when these are put together, again, it's part science in those plans, but there's part art, and just making sure that the actuaries are doing the job the right way. Like sometimes these are sold through insurance companies, and when they are, I find that the actuaries are boring and don't have much creativity. So I don't know where it got set up, but I'm happy to look at it.
Thanks, Ted. We have a lot more questions coming in, so we'll keep taking them as they come in, so please keep asking. Hi, which is better, setting up a 401k of our own or do it by being hired by spouse and under their 401k?
Well, I don't know exactly what that means with the spouse under their 401k. I mean, if they have a business, should you go under their plan or should they go under your plan? I mean, I guess if you're both business owners, you've got to look at where you can maximize the full contribution, right? The employee contributions, if you're doing a safe harbor plan, they kind of are what they are. But the profit sharing contributions can really vary based upon the payroll, the size of the company, in terms of the number of employees, the way that you set up the profit sharing plan in terms of the formula. So, it would just depend. Just got to work through the math to see which one works out better.
Great. Okay. That appears to be all the questions. We are at the top of the hour. I don't want to take more of Ted's time than we already did. So thank you so much again for coming on today with us, Ted. Again, we'll make this available to you in the recording. We'll send it out to everybody in a couple of days. What that means is you'll be able to share it along with the partners at your firm. We have one more question, Ted. Do you have time for one more?
Yep. Yeah, sure. Go ahead.
This is half a question. Eric, if you could continue to ask the rest of it. I only can see the first bit. It's in regards to a Roth IRA rollover.
Yeah.
And there's no second F. Oh, here it is. If you're already putting away in excess of 50,000, you're giving us in pieces. So this is, are you potentially utilizing the Roth plan? So with regard to an Roth IRA rollover, if you're already putting away in excess of 50,000, are you potentially utilizing the Roth plan?
I'm not sure exactly I understand it. I'll reiterate what I said during the presentation, which is that let's say you have an existing Roth IRA that has 100 grand. If you've got a 401k at work, as the employee contributions, you should always have a choice to do a pre-tax option or do the Roth 401k. If the plan doesn't have that, I would cry and scream like crazy. The more technical piece of this is that the plan documents, in order to do the mega backdoor Roth IRA, would have to have the ability for you to do in-service distributions, which means every year you can roll those after-tax contributions, and it would need to allow for after-tax contributions. If it does, you could put away, I'm just saying roughly another 40 grand a year into your 401k with the after-tax money, and then it immediately goes into that Roth IRA. That is why it is called a mega backdoor Roth IRA, and the government really wants to shut it down, I have to say, but as of today, it stands. They may not like it because it's generally wealthier people that do it, but it still exists today. And this is something, like I said, you either need somebody who sets the plan up right, or you should talk to your broker, financial advisor, TPA, and say, well, why don't I have this? You know, and that's sort of the conversation I'd be having.
Amazing. Well, again, thank you everybody for attending. Ted, you're getting a lot of very nice notes here. Thanking you for a wonderful, informative, and time-appropriate webinar, along with just, thanking for presenting the information that is needed in a short and, precise fashion. Again, if people have questions, reach out to Ted and I both. We are two people whose phones are always on, and we're typically willing to work for our clients around the clock. There are a lot of things we weren't able to get to, but these were just the main things we thought we could cover in an hour. So again, Ted, thank you, and hope to see everybody soon. Bye-bye.
All right, thank you.